welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Was a good outcome, and I think just given the sort of the level of fear, right? Given the sort of all this momentum toward the idea of, hey, inflation might reaccelerate this year, I think this is exactly what we needed. It's almost like a sobering report in that regard, because I think too many people were really buying into this idea that you could potentially see as sort of big acceleration in inflation. When I think there's still a lot of evidence to suggest that inflation will actually continue to sort of slow as the year progresses.
I think we're probably at least 2 to 3 cuts away from a resting place of the federal funds rate. Whether we get all the way there before the end of this year, I think really the fiscal policy, the tariff policy that we may get some more clarity on in the coming weeks, that's going to be a big wild card for the economy.
Stability and predictability. They deliver quarter after quarter. You only saw 1% loan growth, which I thought was kind of interesting. And to me, that says that Jamie Dimon's being picky about the assets that he puts on the book. You know, JP Morgan's only half bank, remember. The other half's the investment side. But overall, good quarter.
We got 1 hour to go until the market close, and look at this, a rally, Josh Lipton. We've got the Dow higher by about 789 points right now, 1.8%. The S&P up by 1.9%, and the Nasdaq up a whopping 2.5%. And we have inflation data to thank. CPI, core CPI, coming out a little more mild than expected.
Yeah, this is what a sigh of relief looks like, Julie. In the last few weeks, the narrative really has been sticky inflation. It's been rising yields. We've had strategists come on and say, maybe the odds of the Fed raising rates are ticking up, but today, to your point, core CPI, cooler than expected. PPI yesterday we talked about, that was softer than expected. And so you add them up and maybe giving some more confidence to folks thinking, okay, maybe overall inflation will actually continue to moderate. And of course, earnings we'll talk about too, banks coming out broadly solid, right?
Yeah, so combination really factors. But indeed, that perspective on inflation is leading to a pretty sizable drop in the 10-year yield today, 14 basis points. That is a big one-day move. How is this all then translating back into stocks? Let's take a little more granular look here. So here we have the groups within the S&P 500. Consumer staples in the red. Financials, though, in the green in a big way. As you mentioned, banks reporting, so that's what's going on there. And then we're also seeing consumer discretionary and tech do well. On that front, the Nasdaq 100, you look at a lot of green here. All of the Magnificent 7 is coming back, for example. So that's definitely helping matters here. And then I'm going to pull up the banks as well. But we're definitely seeing sort of this across the board move here in a lot of the different groups. Here are the banks and just a lot of green.
And banks were interesting because it was one of those groups we talked a lot about, Julie. Really had a nice move off that Trump win during the election and then kind of lost some steam there. So there was some kind of anticipation, maybe a little anxiety. How were they going to report? You can see the reaction right there.
Yeah, and especially the trading and investment banking business is really booming at a lot of these banks. We're going to talk about that later. But let's talk about the economic data more right now. That key inflation data coming in this morning with December's consumer price index. While total CPI did hold relatively steady at 2.9% year over year, we did see core CPI come in better than expected on that year over year basis at 3.2%. We're bringing in Aditya Bave, senior U.S. economist at BofA Securities. Aditya, good to see you here. So does this change your view, the data that we got today about what the Fed may be doing?
Thanks, Julie. Good afternoon. Good to see you, too. So it didn't change our view. We still think the Fed's going to be on hold going forward. I think what this report does, and it is undoubtedly good news, what it does is it trims the tail risks of a hike. So we have not been in the reacceleration camp. We've been in the sticky inflation camp. I still feel comfortable with the view that we're kind of stuck around 2.5%. That's where the Fed says we'll be at the end of this year as well. Right, so inflation stuck around 2.5. It's not necessarily reaccelerating, X of policy at least. And the labor market really seems to have stabilized. That's the big driver of our view. You look across the board at labor market indicators, and relative to what we knew when the Fed started cutting in September, they've all either stabilized or improved, which suggests to us that the Fed doesn't need to keep cutting. It's bought the insurance that it wanted to buy.
So Aditya, just to drill down on this point on the Fed's next moves or lack of moves, we had Claudia Sahm on the show earlier, Aditya, today talking about expectations for rate cuts ahead. I want to play you a little of what she had to say. Take a listen.
We are making progress on inflation. It's just very slow. So, this is not, cuts are not coming later this month, but that doesn't mean they aren't coming later this year.
So Aditya, Claudia Sahm saying, doesn't mean they're not coming this year, but you seem to take a different view of that.
Sure, happy to respectfully disagree on that. We think that inflation is somewhat stuck, right? So the first quarter data on inflation are going to be really, really important. That's when the base effects are quite favorable. We think we'll get down to about 2.4, 2.5% by the end of the first quarter, and then we'll just be stuck there for the rest of the year. Of course, if we keep moving down after that, or if we move down faster in the first quarter, then the prospects for cuts would increase. And if we, in fact, only ended up at 2.6, 2.7 by the end of the first quarter, then markets would move the other way.
And Aditya, so if you look at the longer-term inflation trend on a 3-month basis, and this is something that you had in a recent note, there is that clear sort of trend that's intact of disinflation, right? That it has come down, and then you're getting this stalling out. What are you going to be watching most closely, sort of as the inputs to see if we could either get a reacceleration in inflation or further disinflation?
Right, so I think it's dangerous to cherry pick components, but what I would say is on the reacceleration question, you probably want to watch services. If you're worried about labor costs and you're worried about a very strong labor market, very strong consumer, then you would sort of assume that that would play out via services inflation, right? So you want to watch services. You probably want to watch auto prices as well. They've just been a little bit uncomfortably strong the last couple of months. We think this is a blip, but it's something worth keeping an eye on. And then in terms of disinflation, I would say a big contributor to that is potentially rent and OER. They, over the last few months, are just running around where they were before the pandemic. But if they move meaningfully lower, then of course it's going to be much easier to get back to target.
Aditya, now that we have PPI, CPI, curious, what are you looking for when it comes to PCE, the Fed's preferred inflation gauge? What are you modeling?
Yeah, we're looking for a pretty soft number. We're at 14 basis points on the core and about 24 basis points on the headline. So a 1/10 and a 2/10 with risks of each one rounding up to 2/10 and 3/10, right? But these would be soft numbers. They'd be good for the Fed. Again, the caveat would be put that in context of the fact that the last couple months we actually beat the comp, right? So the year over year moved up for a couple months and now it'll move down a bit. The broader trend is the year over year stuck at 2.8 for now, and hopefully the next leg down will come in the first quarter. So again, this one was mostly business as usual, slightly better than expected, but we're much more focused on what happens in the first quarter.
And Aditya, I think we can't ignore the policy elephant in the room, if you will, right? Fiscal policy elephant in the room in terms of what might happen out of the Trump administration and what effect that might have on inflation. There does seem to be, sort of a bit of a debate about tariffs, how they will play out, and then the effect they will have. How are you going to be modeling out, and what are you going to be watching most closely?
So our view on tariffs is that they will probably be inflationary if they're done to the extent that has been proposed, but there's very large risks around that view, right? How much does the dollar absorb the shock? Last time around in the first Trump administration, the dollar absorbed basically the entire shock, right? What sorts of exclusions are allowed? Are the tariffs against consumer goods or capital goods? If they're against capital goods, they end up getting passed through a little bit less. So there's a lot of uncertainty around trade policy, not just the extent to which tariffs will be implemented, but all of the details and the way FX responds to all of that, which affects the inflation outcome a lot. And then on fiscal, there's also a question of timing, because fiscal is not something that can be done via executive action. It has to be done via legislation. And then you have to contend with the fact that Republicans have a razor-thin majority in the House, 220 to 215. so they can only afford to lose up to 2 votes on any potential bill. And I think that will raise the risks of a delay in the eventual fiscal package. We do think the TCJA will be extended, but it could really go down to the wire, so closer to the end of the year rather than the spring as was initially being discussed.
Aditya, another fiscal policy uncertainty, of course, is immigration, possible impacts there on our labor market. How are you thinking about our labor market, Aditya? You know, we had these signs of cooling, not crashing, but cooling. Yep. Of course, we just got that last jobs report, better than expected. How do you see the labor market evolving over 2025?
Right, so we try not to emphasize one print too much because these are very noisy indicators. But if you just look over the last 3 months, right, look at a 3-month average of various labor market indicators, compare that to the same 3-month average based on what the Fed knew when it started cutting, right? And as I said earlier, a lot of those numbers have stabilized or improved, which suggests that the softness that we saw in the summer was a bit of a head fake, right? It was a bit of a blip, and we're now back to a fairly resilient labor market. We do expect that to continue into this year, so job growth might slow a little bit further from here on in, just as, you know, the immigration tailwind kind of fades and maybe turns into a headwind, or labor force participation drops a little bit. But we're not expecting anything disastrous. We basically expect a healthy labor market going forward, which should mean continued wage inflation and continued consumer spending.
Aditya, good to talk to you as always. Thank you.
Thank you.
We're just getting started here on Market Domination. Coming up, JP Morgan notched another record year of profits as big banks kicked off earnings season. We're going to check in on some of today's top trending tickers on the other side. Plus, at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stay tuned. Much more Market Domination still to come.
A new year for markets and leaders that power them is upon us, and that means the biggest names in business are about to descend once more to the ski town of Davos, Switzerland. That's where the World Economic Forum will be holding its annual meeting starting January 20th, which coincides with the inauguration of Donald Trump as president. The biggest names in corporate America will lay out their visions and expectations for the new year on everything from navigating the Trump 2.0 economy to markets and AI. The theme of this year's event is collaboration for the intelligent age. And Yahoo Finance will be there on the ground as always, bringing you actionable interviews with top leaders from across industries. Will serve as your trusted guide to one of the most influential market-moving conferences of the year. So be sure to save January 20th on your calendar and tune into Yahoo Finance all week on our Streaming Now section on our homepage, our app, YouTube, DirecTV, and all major streaming platforms. We'll also be taping special episodes of My Opening Bid podcast, which you can find on all major podcast platforms.
Now time for some of today's top trending tickers. You can scan the QR code below to check out the best and worst and most trafficked stocks of the session on Yahoo Finance's trending tickers page. First up, a look at shares of Intuitive Surgical, the company's preliminary fourth quarter results topping Wall Street's expectations. The stock up 8%. It also presented at the JP Morgan Healthcare Conference today. Intuitive Surgical, the maker of the Da Vinci surgical robot here. And worldwide, it says those Da Vinci procedures will be up 13 to 16% this year versus last year.
Yeah, stock's actually trading here, was it a record high? Preliminary revenue for Q4, $2.4 billion, about $2.4 billion. Beats estimates. Street likes this name, by the way. You see broadly positive and bullish, and why not, Julie? It's still up about 60% here over the past 12 months.
Yeah, and it sounds like most analysts say that it tends to sort of guide conservatively or low in the beginning of the year, and then tends to either come out and raise those forecasts or beat those forecasts as the year goes on. So that helps explain why we are seeing such a reaction in the shares.
Move.
Yeah.
And speaking of earnings, let's get the bank earnings shine as they brought surging profits thanks to a deal-making revival, strength in investment banking. You know, this is one of those sectors we saw a rally after the election and then lost some steam as we waited for the results. Well, the results are in, and they are broadly solid. Bloomberg pointed out here, the four largest U.S. banks, Julie, second most profitable year ever in 2024 for this group. That's interest rate moves, that's investment banking fees, trading, lending revenue. Now attention, of course, looking ahead, Trump 2.0, questions about what does that potentially mean, regulatory oversight, capital requirements.
Yeah, a little bit ironic, right, that amidst some of the big banks complaining about the regulatory environment, that they managed somehow to do so remarkably well. But I guess the assumption is that potentially they could do even better if some of those Basel III requirements do not come to fruition. A couple of things to watch here. Yes, indeed, trading revenue was very strong pretty much across the board here for the companies that we heard from today. JP Morgan, a couple things to note. Their consumer division actually didn't do as well. Profit there was down by 6%, and the company said net charge-offs, so that's loans that are not going to be collected, were up by 9%. And that was mostly in their card business. And we heard that quote from Chris Whalen at the top of the show where he said maybe they're being a little more choosy in who they're choosing to lend to. But that is something that potentially bears watching.
Capital return, also a focus, also a theme. Citigroup, for example, did lower its profit forecast, but did still announce this $20 billion stock repurchase plan. All right, as banks kicked off earnings season with a boom, our next guest expects the good times to keep rolling and for earnings growth to be one of the key drivers of equity markets in the year ahead. For more, let's welcome in now Ed Perks, Franklin Income Investors Chief Investment Officer. Ed, good to see you on set.
Yeah, good to be here.
So earnings season kicks off. Banks report broadly, just talking to Julie there, solid, Ed. Interested though, let's kind of look ahead now for this earnings season. I'm curious what you expect, Ed. What are you looking for? What do you want to see?
Yeah, I think certainly financials, look, you touched on a lot of the great points there, hitting on all cylinders, and more of that expectation going forward that it can continue. Both the capital requirements, some of the regulatory pressures may be easing. So I think financials really have a nice backdrop heading into 2025, and that's reflected in some of the move today. As we move through the rest of the market, it's going to be really a continuation. What we've seen here the past several quarters is that companies have been delivering. And certainly the resilience of the economy, continued strength in the consumer. We'll probably see that again tomorrow with retail sales. Now why we focus more on where is that earnings growth going to be delivered is because valuation multiples have been stretched a little bit these last 2 years. That's what generates outsized gains in markets, right? The combination of earnings growth and valuation expansion, and that we think we want to be a little bit more cautious on.
And so how does that then play out in your strategy?
Yeah, part of it is, the market's the broad. Everybody wants to focus on the S&P 500 or the Nasdaq. Phenomenal gains the last 2 years, but I think when you pull that back, you look at a little bit more of the average stock, been far more tempered in terms of the gains. When you look at kind of dividend stocks, which as an income investor, we do focus on that part of the market. It's a much more reasonably valued part of the market, in our opinion. Companies that can still grow even in an economy that's overall going to be decelerating towards its longer term growth rate. They can generate 6 to 8% earnings growth. They can deliver 3 to 4% dividend yields. We really like that part of the market. It's just something that's been overlooked.
Ed, we're rallying today. Dow's up more than 700 points right here. Obviously, core CPI comes in lower than expected, and I think maybe giving folks some confidence that, okay, maybe overall inflation continues to moderate, and what that means for the Fed. Maybe those rate cuts are back on the table. I'm curious how you were thinking through that. What you made of the CPI print? What do you expect from the Fed?
Yeah, this is a little bit of a relief rally, right? Because there was some nervousness definitely creeping into the markets. The 10-year was pushing 4.8%. Housing, labor market was very strong. And I think this, there is some sensitivity, right? Are we gonna see a stronger number? Are we gonna push towards 5 or through 5% on the 10-year? I'm not sure stocks will like that environment. So I think we got the opposite today. It's a nice relief rally. The 10-year's dropping as well. But I think we have to remember that towards the end of 23, there was disinflation trends, and then we got into 24, and we saw a little bit of a reversal of that. So I don't think we're completely out of the woods here, and there's some dynamics at play as you start a new calendar year where, we might have to watch that. So I wouldn't be surprised if we continue to see economic data that points in kind of different directions, a little bit more of this continued mixed bag that may keep the broader markets a little bit more range-bound in the near term.
What are the implications from bond yields, rising bond yields, for those income companies, for those dividend pays? Because traditionally, it's competition, right, between the bond market and those high dividend pays.
Yeah, no, absolutely, you're right, and especially in a sector, say, like utilities. Now, there are different themes there. There's a growth in demand for electricity from data centers, right? This story. So there's always a little bit of a broader story. But you're right. I think in general, higher rates does provide competition for certain investors in the market, and and it also changes the cost of capital and the ability for companies to finance themselves at rates expected. So you could see a little bit of that. Animal spirits may be coming out a little bit to the extent that borrowing costs do rise.
For fixed income investors who are listening right now, Ed, what is your advice? Where do you see opportunity?
Yeah, well, for the across the fixed income markets, look, yields are attractive as they've really been in the last 5 years in terms of just current income and carry, and that's an important focus, I think, for a lot of fixed income investors. Now, if we look at an area like credit, corporate credit, whether it's investment grade or high yield, spreads are near historical lows. So, I think we're a little bit more selective or cautious in those areas as opposed to, say, a year or 18 months ago when spreads were, quite a bit wider. And there you have that backdrop of if you're constructive on yields and can get some favorable yields over time in terms of declines, that's a nice total return backdrop, right, for corporate credit. We don't think that is as interesting today, but there are other sectors like agency mortgages where yields have risen, pretty significantly. Current coupons are in that 6% range. We think that's something that really stands out for fixed income investors.
Overall, how are you thinking about risks for 2025? I mean, we talked about yields a little bit. Where else?
Yeah, and this is part of why, my initial comment around some nervousness creeping in, right? Yields were rising, and we're now 5 days away from Trump's second term and some uncertainty coming, as the new administration settles in and where that's going to take us, whether it's, tariff policy, what exactly plays out in terms of immigration, and ultimately federal spending, right? So, which is stimulative, and we clearly might see a pullback there.
Ed, great to see you. Great to have you on set. Thanks for joining us.
Happy to be here.
And coming up, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stay tuned. Much more market domination still to come.
From Wall Street to Main Street, America is gearing up for Donald Trump's second term as president. And President-elect Trump is promising big changes. Investors have questions, and Yahoo Finance is bringing you the answers. Will Trump's second term as president bring another year of strong gains for the market? What does the future hold for cryptocurrencies? And which companies are most exposed to those proposed tariffs? Tune in for conversations with experts, analysts, and former administration members, starting on day 1.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're combing through the social media landscape as TikTok's future in the U.S. hangs in the balance. I'm here with Hamilton Capital Partners Chief Investment Officer Alonso Munoz. And it's good to see you, Alonso. Thanks for coming back.
Good to be back.
So let's talk about your buy first, and that is Meta. The stock's already been kind of a monster over the last year. It's up better than 60%. So let's talk about why you still like it and you think it has more upside. First of all, is how it's done financially. And indeed, it's been growing. So you think it's going to keep going?
Yeah, you bet. So it's up 4 or 5% today on the back of positive or better than expected CPI print from this morning. And so, there's a risk on rally. But for Meta specifically, when we look at the revenue, 2022 was a tough, brutal year for the stock. 23 was the year of efficiency, per Mark Zuckerberg. And then 24, we started to see sort of that reacceleration of revenue growth, operating margin, and they have a lot of money on their balance sheet and in cash. So this is a company that investors can get excited about, not just the value of having a big company, but also that reacceleration in growth.
Yeah, and I guess they're not entirely done with efficiency, right? There was just the announcement and the reporting yesterday that they were cutting something like 2% of their underperformers at the company. So I guess they're still working on that. Some of that cash that you talked about, they're putting it into AI.
That's right, and this is not new. We're seeing this across the board. Mega Cap or Mag 7 spending a lot of money building their AI infrastructure. For Meta specifically, I think in 2024, almost $40 billion that they're spending on AI. For 25, we expect that number to be $50 billion, if not more. And so this should continue that sort of gravy train of the company, accelerating growth, investing, and that should be returned hopefully as shareholder value over the next 3 to 5 years.
So how is it going to play out? And that, I guess that brings me to point number 3, product innovation. So how do you think we're going to see that AI and other types of innovation, make its way into those products?
Well, we know they're spending a lot of money on their large language models. Some of them are open source, and so startups, businesses can access those models and develop stuff for themselves. But one thing that we're watching are the Ray-Ban glasses, which are really interesting. It's hardware. Meta's developing that bridge between the software that they have, Meta AI, virtual assistants, and the hardware that you and I can wear as consumers on a day-to-day basis, and hopefully makes our lives a little bit easier.
Do you have a pair of the Ray-Bans?
I don't, but I saw them at a conference last week, and they were awesome. Very cool.
Yeah, I've seen them modeled too. And product innovation, I want to bring up TikTok here because we've seen Meta develop Reels on Instagram to kind of compete with TikTok. If TikTok does end up getting banned in the US, is that then an additional benefit for something like Reels?
I think it's two-sided. It's the user growth, the users that would shift over from the TikTok platform potentially to Meta, but also the ad revenue. I mean, $50 billion, I believe, of ad revenue is up for grabs, and Meta could be a beneficiary if, I think it's 4 or 5 days, if TikTok does get banned and there isn't a U.S. company that takes it over.
Yeah, January 19th is that deadline. What could go wrong for Meta, though? I mean, there are still a number of investigations going on into the company, right?
That's right. So this seems like an easy one to point out, but last year the European Commission fined them nearly $900 million for their Facebook marketplace, and it's just not something that's going away. I think we talked about the election a couple months ago, and with a new administration, we don't think that the FTC is going to pull back from these big tech companies from an antitrust standpoint, and so that's something that could eventually flow down to the financial statements and the bottom line.
That's interesting. You don't think they'll pull back on the investigation, even though Mark Zuckerberg is obviously courting some favor from the incoming administration.
Well, you can see the buddy-buddy action with the president and obviously the administration. I know he's going to be at the inauguration. But it's something that, I don't think that they're going to, it's maybe some of it's posturing. We don't know. I think we'll wait and see how this plays out from a regulatory standpoint.
Yes, unpredictability, I think, is the name of the game. Let's talk about Snap. That is your good buy stock. And this stock is already down a lot over the past year, more than 25%. So we are, we just were talking about competition. I don't know does TikTok going away change the calculus for something like Snap?
Well, a little bit, and it seems obvious to point out a smaller company like Snap versus a Meta. But a lot of investors are looking exactly for that, for a way to play on this TikTok ban. And obviously there's money that's going to flow. There are users that are going to flow. And so for us, we look at the competition that's out there, and it's hard for Snap, given their user base or their daily average user base, to compete against these big companies like Meta specifically.
So if TikTok goes away, you think more users will flow to something like the Meta platforms than they would potentially to Snap?
Well, we think so. And we've seen a bump in Snap stock over the last couple of days. I think it's up 6 or 7% today. And I think investors are front running that a little bit. At least the anticipation that if TikTok does get banned, those ad dollars are going to come and be spread out, and potentially Snap's a beneficiary as well as the user base.
But on the face of it, sort of excluding that effect, do you think the fundamentals of the stock are weak and the business are weak?
That's right. If we pop open the hood, if we look underneath the surface, it's a company that operates at a net loss. They're really digging themselves out of a hole. They don't have as many users as other big companies, and frankly, their user base are generally younger consumers that have less wallet share. From an ad spend standpoint. So when we look at the fundamentals, although the revenue has been improving, it's a company that has a lot of debt. It loses money, and we don't think that investors would want to put their money in a company like Snap.
And then the other side of the coin on innovation here, and it's funny, because Snap also attempted a glasses, spectacles specifically, that didn't work out so well for it, in contrast with the Ray-Bans that you were mentioning.
That's exactly right. The first generation, the second generation, I don't know if you've seen them, Julie, they're big, they're clunky. It's almost like a gag gift that you would get during the holidays. And so when we look at their product lineup and their services, this isn't a company that has the capital to invest in AI. They don't have the balance sheet to really drive growth at their business. And when we look at the innovation in their product pipeline, it's disappointing, frankly.
So what would change your mind on Snap?
Well, this is a company that if they can continue to grow their user base, if they can clean up their balance sheet, and management can do a good job of raising capital, this is a company that maybe is a turnaround play, as well as a TikTok. If TikTok truly is banned here in the States, they may be a beneficiary in the short run from that ban.
Do you have a position in either of these names?
We own Meta, we don't own Snap.
Gotcha. Okay. Well, thanks so much for being here. Good to see you again, Alonso. And thank you so much for watching Goodbye or Goodbye. We'll bring you new episodes at 3:30 p.m. Eastern.
All right, let's get to some calls. The day now, UBS raising its price target on Spotify to $5.40. Maintains the buy rating on this one. 2024 was a year of progress towards intermediate financial targets, they tell their clients. They expect momentum to continue in 2025, supported by, they point out, 23 million premium ads, a focus on product enhancement, and yes, they expect gross margins to continue to expand, Julie.
And they also talk about, on that point about margin expansion, they do mention that there's a launching of a partner program that they say might put a little short-term pressure on margins, but that should be good over the longer term. They also talk about price increases sort of making their way through the system and being positive as well. And they're also looking for the company to eventually launch premium or super fan tiers. Spotify has just announced some of that more tiering pricing. It's sort of a new thing for it, but I guess they're looking for even more tiers to come.
Stock has been a monster. I mean, you just pull up the chart. They're 140% in the past 12 months, and UBS says stick with it.
Still going. Yep. And also, we're looking at Edison International. Ladenburg Thalmann upgrading that stock from sell to neutral. The note citing the utility company's valuation following the sell-off that we've seen caused by the wildfires in Los Angeles. Now, what we've been saying every time we've been talking about Edison International and some of the other utilities in California is that we do not yet know, of course, what sparked the wildfires. We don't know if Edison will incur any kind of liability as a result of it. But investors have certainly been acting as if they might, right? And so we've seen that stock selling off here. The analyst says that it does reflect reasonable worst-case outcomes associated with the wildfires, but that it's too early to know what's going to happen.
Yeah, it says an initial assessment of Edison's Southern California utility role in the start of the fires likely won't occur, they say, until the summer of 25 at the earliest. Does lower, it looks like, EPS estimates and trims the target to 56.50.
Yeah.
All right, our next guest hopes the Federal Reserve made a resolution on New Year's Eve, one that would lead to better communication and less biased decision-making. Joining us now is Jason Furman, professor at the Harvard Kennedy School of Government, former CEA chairman under President Obama. Jason, it's good to see you. So you write in the Journal, New Year's resolution for the Fed, Jason, embrace clear monetary policy rules. Walk us through the op-ed, the argument here, Jason. What would placing this greater weight on rules solve for?
Yeah, so look, there are people like John Taylor that have been pushing this for ages. I used to be skeptical. I thought the people in government just knew much better than any rule, so better to delegate a lot of discretion to them. I feel a little bit less warmly about that right now. And so would rather they publish every meeting, every 6 weeks. Here's what the rule said we should do. Here's why we did something different. They don't have to follow the rule, but it places just a little bit more weight and emphasis on what it is.
They go by some rules already, right, Jason? I mean, would what you're describing, would it have, sort of allowed them to do a better job in anticipating the spike in inflation, for example, and maybe mitigate that?
Yeah, I mean, they would have responded sooner. Basically, they used their discretion and they said, you know what, we're seeing a lot of inflation, but it's transitory, so we're not going to raise rates. The rule basically would have said, we don't care what your theories about the future are. When inflation goes up this much and the unemployment rate goes down that much, here's what you do to interest rates, and that would have been a lot closer. Then let's go to the recent episode. Part of what sort of pushed me over the edge was the December rate cut. All the data that went into that was inflation higher than we thought, unemployment lower than we thought, and then somehow they're cutting rates. And I think that's just because they said they were going to cut rates and everyone expected they were going to cut rates, so why not cut rates? Well, the rule makes it easier. You know what? We did not change our position. It's just the data changed, and when the data changes, we change interest rates.
If you did that, Jason, you embrace clear monetary policy rules. I'm just curious, what then? How do you think about sort of the role and place and benefit of judgment is there? How do you balance these?
Yeah. So sometimes it's pretty easy. March 2020, they cut interest rates to zero. Absolutely the right rule. They knew the right move. I mean, the rule would not have said to do that, but they had a lot of data that wasn't, in the rule. So this is just putting a little bit more weight on what's worked well in the past and a little bit less weight on their judgment, because we all like to think we have great judgment. Theirs is better than most, but it's still pretty fallible. And part of what I worry about is it's somewhat biased. So another part of what I suggested was the long run goal should be an inflation target, but they should also say in the short run, in order to cut out the noise, here's the main thing we look at. And so the market all knows they're looking at, let's say, market-based core PCE for the inflation measure. That would be my recommendation. I'd be fine with something else, but you're not constantly changing. Oh, this month, let's look at this inflation measure. That month, let's look at that inflation measure. No, this is the good one. This is the one we look at.
Do you think this also provides a bit of defense in a charged political environment, Jason, more than they have currently if they're sort of getting leaned on from the administration, for example?
Yeah, I think it provides some help in that regard. I don't think Donald Trump would be overly impressed with whatever rule they had and overly deferential to it. But I think a lot of other fair-minded people, if they have to raise rates this year, and they might have to, and they could say this is not a policy change that we wanted to punish everyone by raising rates, but we had a formula, and it said if inflation moves higher than we thought, we raise rates automatically, basically. That works. Now, a longer track record with it would be better and more credible than just launching it. But, when is the best time to plant a big tree? Well, 15 years ago. But if you can't do that, just start it today.
You mentioned their inflation target, Jason, so I'm just curious to get your take on this, because do you think they should stick with that target? Because there's some folks, and you've heard them, Jason, who say, maybe it's time they kind of reconsider that level of specificity. But what do you think?
There's two things. One is, should they raise the inflation target? I've been in favor of that in the past. I've grown more skeptical of it. I think the need for it has gone down now that the neutral interest rate has risen. And the benefits of, credibility are even more apparent than they were a couple of years ago. There's then a second thing, which I think is what you're asking in their question. I do not think they should be overly precise about it. I, for example, would change the inflation target from 2.0% to 2%. What's the difference between those? 2.0 is a false precision. If you're at 1.8, you're at 2.2. That's way more than good enough. You should not fret about being away from the target. I think 10 years ago, there was a lot of nervousness. Oh, they're only at 1.8 and the target is 2.0. That nervousness was mistaken. So I think a little bit, if it's not a range, just even a blurrier, rounded target rather than a very precise one.
Jason, I want to turn to the incoming administration's fiscal policy a little bit, because there is this debate that's been heating up about tariffs, about whether they're going to be inflationary. Obviously, we don't know how they're going to be enacted as of yet. But I'm curious where you stand in your thinking on that.
Yeah, so as you said, we have no idea what we'll get. My guess is we get an average tariff rate of about 5%, so 10% across the board, but with a lot of exceptions for countries or certain goods, and then something even higher on China. But regardless, I think whatever you do is a temporary increase in the price level. It's partly offset by an appreciated exchange rate, but only partly. You can say that's not inflation because it doesn't permanently raise the inflation rate, but it's a higher inflation rate in 2025, a higher inflation rate in 2026. And I think the Fed would be hard pressed to ignore that. Now, the increase is only a couple tenths, but let's say without the tariffs, inflation would have been 2.4, and with the tariffs, inflation is 2.7. That's a big difference in terms of what the Fed does with its rate trajectory.
And finally, Jason, interested to get your take. The move we've seen in the 10-year, I'm curious what you chalk that up to. Is it concerns about fiscal deficits, or some people have come on and say no, it's not. It's growth, it's inflation. But I want to get your take on that.
Of course, it's all of the above. If you look at the pricing, it's happening more in the real rate than it is in expected inflation. That is what you would expect to see in a world where you have high debt and people are worried that the debt will continue to go higher. So I have no doubt that fiscal is a part of it, but certainly shifting to a belief that the neutral interest rate is higher, as well as inflation is going to be stickier, is a part of it as well.
Jason, thanks so much. Good to see you.
Good to see you.
Let's do a quick check of the markets as we count down to the closing bell on Wall Street. All three major averages here getting a big boost from those milder than expected CPI numbers. The Nasdaq leading up 2.5%. Stick around, much more market domination still to come.
A new year for markets and leaders that power them is upon us, and that means the biggest names in business are about to descend once more to the ski town of Davos, Switzerland. That's where the World Economic Forum will be holding its annual meeting starting January 20th, which coincides with the inauguration of Donald Trump as president. The biggest names in corporate America will lay out their visions and expectations for the new year on everything from navigating the Trump 2.0 economy to markets and AI. The theme of this year's event is collaboration for the intelligent age, and Yahoo Finance will be there on the ground as always, bringing you actionable interviews with top leaders from across industries. Will serve as your trusted guide to one of the most influential market-moving conferences of the year. So be sure to save January 20th on your calendar and tune into Yahoo Finance all week on our Streaming Now section on our homepage, our app, YouTube, DirecTV, and all major streaming platforms. We'll also be taping special episodes of My Opening Bid podcast, which you can find on all major podcast platforms.
Department of Transportation has sued Southwest Airlines, alleging the carrier operated chronically delayed flights. The lawsuit follows a DOT fine on JetBlue Airways for similar allegations, and it has to do with particular routes here, I guess from Chicago Midway to Oakland, from Baltimore to Cleveland. But it was back in 2022 that they said this chronic lateness was happening.
Yeah, so they're suing for allegedly violating rules on realistic flight schedules, it sounds like, Julie, just reading through the reports, chronically delayed flights. Southwest Airlines is responding saying, listen, this suit is based on 2 flights from over 2 years ago that they say they've operated over 20 million flights with no other such violations for a while, since 2009. The other kind of wrinkle here is, of course, this is all last remaining days here of the Biden administration.
They've been busy.
They have been very busy, so the question becomes, with President-elect Trump moving back into the White House, what actually happens to a lawsuit like this? I guess we'll wait and see.
We will find out. Uncertainty on the Fed's rate cut path, Trump tariffs, a jump in Treasury yields, making for a turbulent run for markets in January. What does this mean for the options market? Sai Katara, Top Alpha CEO and founder, joining us now to discuss in the options pit, sponsored by Tasty Trade. Thinking we're in the options pit, surrounded. Anyways, thanks for being here. So indeed, there are a lot of cross currents right now, and we've seen an uptick in volatility. What kind of environment is that for an options trader?
It's interesting. It's sort of an ideal world. First of all, thanks so much for having me. You think about fixed income, and that's kind of connected to the cost of capital. Well, options are connected sort of to the reward of volatility. So the more volatility you get, the more option premium is available for any particular risk profile. So it creates a really interesting moment for options-related strategies, options-related ETFs, and options-related traders in order to take advantage of that volatility. And that's sort of the name of the game, I think, as we start the year with a little bit of a rocky road.
Sai, you are also the man behind this ETF, the TSPY. Curious to hear more about that ETF. What's its purpose? What's its mission, Sai?
Yeah, I appreciate it. So TSPY, the goal is we own the S&P 500 long in the underlying. It's a buy and hold product. But one of the things that we learned is that there's an opportunity to take advantage of this new zero-day option capability to sort of harvest additional income for investors in the fund. And so as volatility rate rises, the option premiums that are available to go out and harvest and collect on behalf of investors grows as well. So if you're a long-term investor, short-term volatility you're less worried about. But by turning on this mechanism, you can actually take that volatility and use it to your advantage. And sort of that's the theme behind T-SPY as an ETF. And that's why it's sort of a volatile environment where people are wondering, hey, is fixed income going to help bridge the gap for income? Option-based strategies are a really interesting way to take advantage in order to fill the gap.
And I know in general, covered call strategies have sort of gained in popularity in this environment. Tell people what a covered call is and why right now seems to be a good time for them.
Yeah, covered calls, essentially, it's low to moderate risk strategy. It's one of the only strategies that you're actually allowed to trade in an IRA account. But basically, you own shares of an underlying security, and then you sort of sell the opportunity for someone else to buy that security away from you at a higher price. And so when you do a covered call, you're able to mortgage the value of what you have to collect a little bit of income premium today. And so in flat markets or down markets, it's a really interesting way to sort of hedge downside risk that you have. And if you're expecting that the growth of the capital markets over the next year or so is going to be flat, this is a good way to juice up or take benefit from volatility by employing a covered call strategy to sort of help harvest some income.
The rise in popularity, Sai, of trading platforms has, of course, increased access to options. I'm just curious, Sai, in your opinion, who should be trading options? Who should, who shouldn't? How do you think about that?
Yeah, options can be used. They're a tool, and they can be used in lots of different ways. So, some uses of options are almost like insurance. You can buy an option, and if you want to protect downside risk, that's a way in order to sort of take some risk off the table from the downside. So it really depends on how those are being used. There's uses of options where it's very high risk, where you're writing options, you're selling them, but you're doing it without the underlying security to collateralize it. That's risky, because options move significantly differently than the underlying securities do. So, the option usage needs to match the risk profile of the person using it. So retail investors absolutely can learn about the tool to look sort of hedge different positions, but ultimately, one of the reasons that we loved being able to package a strategy in an ETF is because we're able to create a risk appropriate product for low to moderate risk investors and manage the process for them. So they don't need to get into the nuances of how to buy and sell options. We're transparent about it and they can see those trades as they happen every day, but it helps to provide a low to moderate risk way to generate some income without having to get into the complexity of how to manage them yourselves.
In general, though, Sai, we have seen an explosion in options trading. And so I guess I would ask, writ large, are there any systemic risks or risks of people losing a lot of money on a broader scale? Have you seen any of that kind of creep its way in?
It's one of the worries that people sort of mention with this popularity of zero DT options. So 0-day options are ones that are basically expire same day. So they're super short term. And the worry, and by the way, this has exploded in popularity. I think almost half of the options that are traded on the S&P 500 are 0-day options. And a lot of it, that has been driven by the retail market. The worry, though, about how is that going to impact potential movements in the underlying securities, exchanges like CBOE, for example, have a lot of data and statistics around it that say, well, actually the buying and selling, even though the explosion is there, it's been balanced. And so that's what sort of kept the risk at bay for that exploding into a big market movement where you're going to have a big gap up or a big gap down based on options trading activity. But yes, the explosion has been there, but so far it's been balanced, but that's the risk that people worry about.
Sai, great to have you on the show today. Thank you so much for joining us.
Thanks for having me. Appreciate it.
And while wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.
the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. Let's take a look at how this big rally ended up on the day. The Dow finishing pretty much near the highs of the day here, but pretty steady throughout, up about 700 points here, good for a gain of 1 2/3%. The S&P 500 up 1.8%, and the Nasdaq, the clear leader here, up by nearly 2.5%. Of course, as we've been talking about, the uptick in yields that we have seen has seemed to trigger the most volatility in selling within the mega cap tech trade. And so it makes sense that with yields trading lower today on the back of the milder than expected year-over-year core CPI report, down 14 basis points on the 10-year, that it would be indeed mega cap tech that benefits the most. A couple other things that I want to point out here, however, just emphasizing the gains in the S&P 500, the preponderance of those gains because of mega cap tech. You can see that in the performance of the S&P equal weight, which underperformed the S&P 500. In other words, it really was those largest cap stocks pulling up the index here. Also want to note, though, that the smaller cap stocks did well, too. In fact, they outperformed the S&P 500. Again, this thinking that as rates come down, that's going to benefit some areas more than others. The perception is that small caps are going to do well in that environment. But, of course, it wasn't just mega cap tech that was rising today in the big stock category. There was another group that was also doing very well, and that was the banks. You look at a JP Morgan up 2% on the day after that company came in with record profits. And I just want to take a look at the year to date here. Obviously, there hasn't been that much time in the year to date. Let's stretch it out a little bit and look at the 3 months. Look at it since the election. As we've been talking about, had kind of been fading that post-election rally before this pop that we saw today as a result of these earnings here. Wells Fargo also out with these numbers. Its numbers up 6.6%. Goldman out with numbers up 6%, and Citi out with numbers up 6.5%. But you see banks broadly rallying, and we're still going to get numbers from the rest. Bank of America yet to report, Morgan Stanley yet to report, et cetera. So we'll be watching those numbers very closely. And then if you go back on over here to the largest cap tech stocks here, a lot of green on your screen here. Tesla coming back by 8% here today. NVIDIA bouncing by 3.3%. So you had the earnings theme and then the CPI rates theme really giving a lift pretty broadly across the market today, Josh.
All right, Julie. The bulls roaring back on Wall Street thanks to strong bank results and core inflation growth slowing last month. And on the flip side, the yield on the 10-year sliding roughly 14 basis points on the day. For more on the latest market action, let's welcome in now Ed Yardeni, Yardeni Research President. Ed, always good to see you. So you wear two hats, Ed, economist and strategist. So let's start with your role as the former. As an economist, I am curious to get your take on that CPI report we got today. Ed, what did you make of it? What do you think the Fed makes of it?
Well, it was very good news. The top line in yesterday's PPI and today's CPI were better than expected. But still, there's still some sticky areas of both inflation rates in the services area. So I think it still keeps the Fed on pause. I don't know that they've officially announced pause, but I think the markets have figured out that the Fed probably won't be lowering interest rates anytime soon. And meanwhile, the bond market loved that inflation number because I guess there's a lot of fear that it would be a hot number. We thought it might be on the hot side. And so there must have been a lot of short covering in the bond market, maybe some players thinking we're going to go to 5%. And we didn't do that. We're very comfortable with the bond yield being around 4.5%, sort of on a trend long-term basis. So we have no problems with what's going on in the bond market. And then, of course, as you folks just mentioned, that's turned out to be very good news for the stock market overall.
But how sustainable is this, Ed, I guess? You know, because we had been seeing yields creep up and up and up. Yeah. Today was just one report. Is that inflation Correct. Demon vanquished?
No, I don't think it's vanquished, not if the target is 2%. And the Fed has made it very clear that for the sake of their credibility, they intend to get inflation down to 2%. I just think they got a little bit too confident that if they lowered rates, that inflation will continue to decline towards their 2%. And there's some areas where that's just not the case. We're not at 2% on the inflation rate, and we're not there on a sustainable basis. So there could still be some issues here. We know that energy prices pushed up the December number, and they'll do the same for January. We know that food prices can be volatile. So no, we're not out of the the woods when it comes to getting inflation down to 2%, but we're awfully close. So I don't know that the markets basically says, well, it's close enough. And meanwhile, the economy is looking good. Earnings are great. The financials are doing extremely well. So it's kind of a roaring 2020 sort of day today.
When do we get back to that 2%, Ed? I'm just curious, as you try to model out a possible timeline, what does it look like?
Yeah. Well, we're big believers that productivity growth is making a big comeback here. We think we're in a productivity growth boom as a result of all the technological innovations that can help augment the productivity of workers. And so if we don't do it later this year, I think we'll see 2% inflation next year.
Ed, going back to yields for a second, I did want to bring up a term that we have noticed popping up a lot in interviews when talking about fixed income, and that is the return of the bond vigilante.
Yeah.
It's a term that you coined back
Yes.
in the 80s. The definition, for those who don't know, is investors who sell government bonds in response to fiscal policies that they view as inflationary, which would then drive up borrowing costs for
Correct.
the government. So there's a lot of talk about this incoming administration, about its fiscal policy being potentially spendy, and what that's going to mean, if that's going to augur the return of the bond
Correct.
vigilantes. What do you
Yeah.
think?
Well, I think it's still a relevant risk. I mean, it certainly looked like a more relevant risk a couple of days ago. But markets will be volatile on a short-term basis. I think there's still a lot of concern in the bond market about undisciplined fiscal and monetary policy. I think the fact that the Fed lowered rates by 100 basis points and the bond yield went up 100 basis points was a clear indication that the bond vigilantes, so-called, just didn't agree with what the Fed was doing. And the interpretation I got was that the bond market was basically saying that the Fed was stimulating an economy that didn't need to be stimulated. So that's kind of where the bond vigilantes are. But at some point the yield becomes very attractive here, and you get to 4 3/4. Anything close to 5% is something that people want to lock in. And just the fact that many people were waiting for 5% frustrated them because they're apparently not going to get it today, certainly. But yeah, then it's still a problem. And I think the jury's out. The bond market, the bond vigilantes want to see how the Trump administration is going to put together all the pieces of their proposal in a way that gets us some relief on the deficit outlook.
And I think the last time we spoke to you, I was asked you, what sectors you wanted to be overweight. I think, Ed, it was technology, financials, industrials. Would you still want to be overweight those sectors here?
Yeah, absolutely. They're not cheap. They've already been in a great bull market, but their earnings outlook remains very strong. And so I think from here on, the bull market continues on earnings and less on valuation. And again, I think we got a glimpse of that today when better than expected earnings from the financials drove their stock prices higher. That's what I'm expecting.
And when we look ahead to earnings season here, which of course we're just starting to get into, what are you sort of most focused on? What do you think is going to be most important for investors to watch for?
Well, I actually thought today and tomorrow the financials would be most important because to really get a sustainably strong bull market, it's very, very helpful to have a strong financial sector, and that's what we have for sure. I think we need to increasingly convince investors that even though valuations are high in the tech area, this is not going to be a repeat of the late 1990s and early 2000, the tech bubble followed by the tech wreck. I don't think that's what we're looking at. I think we're looking at earnings continuing to march higher for tech, communication services, industrials, because I think the U.S. economy is on course for a productivity boom based on the technologies that are available to accomplish that.
Ed, great to see you as always. Thanks so much.
It was a pleasure. Thank you.
Scott Bessent's Thursday Senate confirmation hearing could provide clues for market watchers trying to sort out some of the early mixed signals about Trumponomics 2.0. Joining us now to help us figure out what signals to watch, Yahoo Finance's Ben Werschkel. And you were out with a piece today describing just that, kind of what we should be looking for, Ben. So give us a guide.
Sure, thanks. Good to see you, Julie. So 3 things to watch for you. One is where there's no drama here, which is the question of Besant's confirmation. Unless there's something major that comes up, he's been on a glide path to confirmation since the beginning, and there's sort of no hint of opposition among Republicans. Where there is some drama is on the Democratic side, which is essentially how hard will Democrats push on him. This is a panel with Elizabeth Warren on it, Bernie Sanders on it, and Ron Wyden is the top Democrat who's pretty prominent on these issues. The question is, do Warren and others, Warren who has 31 pages of questions, she's not going to be able to ask all of them for him. How hard do they go on him? Do they get into issues like his business ties and things like that? What the markets will be watching here, I think, are these overall issues that he's owed. There's a couple issues that arguably we don't have a lot of clarity on just 5 days from Trump's inauguration. The first one is tariffs. I've been on with you guys, I think, a couple times this week talking about how we had this kind of semi-public debate about tariffs. Are they blanket tariffs? Are they gradual tariffs? All these things that is sort of symptomatic of a debate within Trump's world that's ongoing right now. So Besant's comments there will be closely watched for any insight into Trump, who hasn't really been clear on what he wants to do, as well as with Besant, what he's really going to be pushing for once he's in office. And then the second is debt and taxes. That's Besant's main role going in will be to shepherd through tax cuts. And the Republicans are pretty split at the moment on whether they can pass a bill and sort of add more red ink, or do they need to pay for this? And so Besant has been kind of in the middle of that, and so he's going to be pressed on that for certain by both sides of this. The bottom line here for folks is Besant is going to be the next Treasury Secretary unless there's some major thing that pops up. But what we're watching for tomorrow is kind of how he's going to operate and any insight into how Trump's going to operate in just 5 days when he's in office.
You know, Ben, a picture could be worth 1,000 words, right? Senator Schumer there. Taking pictures with Besant, all the smiles for Chuck.
Exactly. No.
Do we read anything into that, Ben?
Yeah, for sure. Pete Hegseth definitely did not get a picture with Schumer. So I think you're apt to say that's a very different dynamic. That said, Schumer and Warren and Elizabeth Warren are very different kind of within the Democratic caucus. So I think you will see some fireworks tomorrow. But as Schumer's move there points out, Besant's going to get some Democratic votes, and he will get through for certain.
Ben, great to see you. Thank you.
Talk to you then.
And be sure to tune in to Yahoo Finance tomorrow for live coverage of Scott Besant's confirmation hearing. It starts at 10:30 a.m. Eastern Time. Stick around. Much more market domination overtime coming right up.
From Wall Street to Main Street, America is gearing up for Donald Trump's second term as president. And President-elect Trump is promising big changes. Investors have questions. Yahoo Finance is bringing you the answers. Will Trump's second term as president bring another year of strong gains for the market? What does the future hold for cryptocurrencies? And which companies are most exposed to those proposed tariffs? Tune in for conversations with experts, analysts, and former administration members, starting on day one.
Social media giant TikTok in the hot seat as it faces a potential ban in the U.S. due to worries over its ties to China. But it's not the first company to spark security concerns from that nation. Before TikTok, Chinese corporate juggernaut Huawei shined a light on China's rise as a rival to the U.S. Our next guest details this and more in her new book, The House of Huawei. Here to discuss the author Eva Do, who's also a technology policy reporter at The Washington Post. Eva, thank you so much for being here. I do want to start on TikTok, since it is the hot topic du jour. You have written about that as well. Given what you saw and what you found in your reporting on Huawei, how does that inform your thinking on how this TikTok situation could turn out, particularly the approach from China?
Yeah, certainly. There's very much a parallel between the focus on Huawei during Trump's first term and now TikTok as Trump's second term begins. And so for both companies, they're very different on the surface. Huawei makes telecommunications equipment, the stuff that makes up phone and internet networks, while TikTok, of course, is this social media giant. But for both of them, sort of what has sparked the concerns is that enormous amounts of data are involved on the back ends of these companies for user data of Americans. And right now, in the current U.S.-China climate, there's enormous concern among the security community about that.
Eva, what seems to also link kind of TikTok and Huawei here is this belief among a lot of American lawmakers on both sides of the political aisle at this point that China is an adversary. China is run by the Chinese Communist Party. There's no distinction over there between the martial and civilian, and therefore Chinese companies can pose this national security risk. In your opinion, is that a fair assessment?
Well, I think a lot has changed in the political climate, and that's the reason for this change in assessment. And that for many years, the big trend was globalization, and that was based on these fundamental assumptions that countries were going to work together, that we weren't in another Cold War, that it was safe to do trade and to share technologies. And so there's been major changes in sort of worldview, both in the United States and in China, among policy makers in the past couple of years, recognizing that we are in a sort of new era of great power rivalry. The United States is still significantly ahead of China, but China is narrowing the gap in a way that's really concerning to Washington. And that means, what was considered a manageable threat before is now considered something that policymakers aren't willing to accept.
Well, and what's interesting too, Eva, is that the constraints that the U.S. put in place on Huawei, for example, actually, ironically, might have led to more success for the company in some ways, right? In terms of, or more success, I should say, maybe for China in terms of homegrown development. Is that fair to say?
Yes, certainly. So this becomes sort of a self-fulfilling prophecy of the divergence of the global supply chain. Like at the beginning of the first Trump administration, it seemed very unlikely when people talked about a decoupling of the global technology supply chain of the US and China parting ways and developing parallel systems. And, in the past 8 years, we've seen that turn into a reality, really, and sort of a bipartisan consensus. And so now TikTok is the latest sort of step that so not only the hardware, but also social media is going to be separated very likely between the countries.
I'm curious, in your research, how have U.S. sanctions impacted Huawei? How has it affected the business?
Well, U.S. sanctions have definitely blunted Huawei's growth. So before the sanctions, Huawei had been growing year on year, just expanding its global presence. And so U.S. sanctions definitely stopped that. And during the Trump administration, there was the question of, would Huawei be able to survive this? Is this a survivable blow? And sort of the answer that we can say now is Huawei's very much survived. China has pulled out all the stops from the top levels of government to make sure that this national champion does survive. But it's no longer on the trajectory that it was before.
We know also that the Biden administration has been increasing its use of export controls, sort of continuing on the work from the first Trump administration and expanding on that, even just in the last few weeks, coming out with some new controls. How is China sort of responding and adapting when those kinds of things are put in place?
Yeah, so that's something that surprised a lot of people about the Biden administration is they didn't reverse Trump's export controls on China. And in fact, to double down to, these last days of the Biden administration, they've been rushing these last packages of export controls on China for technology out the door. So China has largely been responding in kind. They've been putting U.S. companies also on restriction lists. And so, with each step, it leads to another step. And you see sort of the technology ecosystems diverging more year on year.
And to that point, Eva, I mean, now, we're days away from the inauguration. In Trump 2.0, you have real national security hawks, on China. I mean, think of Rubio, think of Waltz. I'm just curious what you think that could mean for Huawei, just for Chinese companies generally.
Yeah, certainly. It seems the general direction that we can expect is tougher policies on China in general. If you look at the people that Trump is hiring, a lot of security hawks, a lot of policymakers who have been very outspoken and very critical of China over the years. So that's the general trend. Well, that being said, Trump also has a reputation as a deal maker. So there's the chance that on specific issues, he's willing to trade off one thing for another to come to sort of the bigger deal he has in mind.
And even finally, the law as it was written isn't just about TikTok, or to get back to TikTok for a moment. And I'm curious, given your experience with Huawei and then your reporting on TikTok, what do you think could be other potential targets? I mean, certainly there are an increasing number of Chinese companies that want to access the U.S. market. You look at something like Temu. You look at now the migration of some users from TikTok to another Chinese app called Red Note. Which do you think are sort of most likely potentially to be on the future hit list on the part of regulators?
Yeah, well, there has been quite a bit of discussion in Washington about, where to go from here. And I think both Democrats and Republicans, there's been talk of taking a closer look at other emerging technological fields. Everything from batteries to robotics to cloud computing and quantum computing. These kind of technologies that are going to be are seen as being pivotal, 10 years, 20 years from now. I think both in Washington and in Beijing, officials are taking a very close look at them right now.
Eva, great to see you. Great to have you on the show, and congrats on the book.
Thanks for having me here.
Time now for What to Watch, sponsored by Tasty Trade. Trump's Treasury Secretary nominee Scott Bessent is having his confirmation hearing tomorrow. Wall Street will be listening for any commentary ranging from anywhere from tax cuts to tariffs, as well as the government's conservatorship of Fannie Mae and Freddie Mac. Tune into Yahoo Finance tomorrow for live coverage of Scott Bessent's confirmation hearing. That coverage is going to start at 10:30 a.m. Eastern Time.
And guess what? We have more bank earnings tomorrow, including Bank of America, Morgan Stanley, and U.S. Bancorp. Bank of America will announce its results for the fourth quarter in the morning. Analysts expect net interest income will be bolstered by a higher for longer interest rate environment. And we'll also be getting numbers from United Health Group and Taiwan Semiconductor. Investors will listen for any commentary on the United Health call following a report from Reuters that shareholders are urging the company to analyze the impact of its healthcare denials following the killing of CEO Brian Thompson last month.
And taking a look at the economy, monthly retail sales data coming out in the morning. Economists forecasting sales to slow to 0.6% on a month-over-month basis.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. And here's some of the trends we're going to be diving into. A big day for markets after another encouraging inflation report, with each of the major indices seeing a boost. The Dow rallying over 700 points, while the Nasdaq closed up nearly 2.5%. We're going to dive into the rest of today's market trends. Then, as Donald Trump gets set to re-enter the White House House. U.S. spirit companies bracing themselves for retaliatory tariffs from other countries. We're going to break down just how hard liquor brands and bourbon brands in particular could get hit. Plus, robotics, one of the biggest themes coming out of this year's Consumer Electronics Show. But the machines aren't just for the future. They're here now. And we're going to talk to the CEO of Gecko Robotics. Well, stocks close higher as inflation cools and bank earnings dazzle Wall Street. Yahoo Finance's Josh Schaefer joining us now with more on the trading day takeaways. Josh.
Hey, Josh, yeah, we've been talking for several weeks now about the rise in the 10-year yield, the rise in rates overall, and how that's been a headwind for stocks. Well, stocks got good news today. Inflation print comes in soft for December, that December CPI report. Here's a look at the 10-year yield. Finished down 14 basis points, down to 4.65, Josh. Of course, if we zoom out a little bit here, let's look at a 7-day look. It had been tracking higher. If we go out even a little bit further, let's look at a 2-month. This had been our headwind for stocks, right? If I turn my pen on, we'll draw. This had been our headwind for stocks. You finally get a little bit of a breather and look at what happened in your market action off that. The S&P 500 up almost 2%. Big rally in tech today too, Josh, which was interesting. We've talked about, yes, rates are coming down, but rates are still high. Where have investors favored right now in this high rate environment? It's been large cap tech, right? Take a look at what happened to the Mag 7 today. They were one of your clear leaders in the market as we saw this reaction overall.
Sigh of relief, because the last few weeks we've been talking, it's all been about sticky inflation and the 10-year for good reason. We're checking on that. We've had strategists come on, so I don't know, maybe they're actually going to raise rates this year.
Right.
And it feels like maybe that, CPI today and PPI yesterday, maybe at least changing the narrative.
And what's going to be interesting, Josh, is it feels like it changed the narrative for today of when is this ever going to stop, right? But again, we'll go back to this 10-year chart one more time. I think it will be interesting to see where we go from here, right? We're sitting at 4.65 now. If I zoom out again over the last year, we're still high, right? And I think the question is, this rise that we saw here wasn't all about inflation expectations, right? There's perhaps fiscal spending, other things maybe driving that
deficits,
up, right? And so at some point, do those other things start to come into play and push yields back up and continue to be ahead? When we have one fixed income strategist on our show Catalyst this morning that sort of teased that out. He said maybe it's too early to sort of call top on this 10-year rally that we've seen thus far.
And if yields keep moving higher, can stock market rise too? Can stocks move higher with them?
Hopefully, if inflation is falling, right, Josh? And that was one of the things we saw today. We'll get to trading day takeaway number 2. I felt like the hike debate dissipated a little bit, right? So remember after that Friday non-farm payrolls report that was hot, we had some economists come out and say, look, Fed's not cutting this year. There's no way the Fed's going to cut based on these inflation trends, hot economy, and it felt like a hot inflation report today was only going to feed into that. But we got some pretty good news. So what I wanted to highlight here is the shelter index. Shelter prices increasing 4.6% in December, the lowest level that we've seen in 2 years. And this has been a lagging fall, right? Look at overall inflation falling, core inflation without shelter falling. Shelter has taken a while to fall. This has been something Chair Powell has talked a decent amount about. And there was one economist from Jefferies today, our friend Tom Simons. He said if you can keep getting shelter to come down like this, there's a case for the Fed to cut here. Part of your inflation dragon is being slayed as shelter inflation comes down.
The other big issue, though, too, is so much fiscal policy uncertainty. Right. And what that could mean, and we talked about this, Josh, for inflationary pressures about taxes, tariffs, immigration.
Right. What does that do to our blue line, right? That's already starting to creep up a little bit again, right? That's headline CPI. If we get later in the year with these taxes, tariffs, all of these different things that Trump policy could bring for us, does that line keep moving up? And is there a chance the Fed doesn't cut? I think that's still very much on the table, right? I don't think one economic data print is ever going to be the full trend for us. We're going to need to keep watching that. But let's move on to takeaway 4, Josh, or takeaway 3. More good news. Solid earnings from the big banks today. So I want to just highlight the market action that we saw from that, because really what I think part of what helped with this macro narrative today, Josh, is once we get out of, here's your XLF leading the sectors today, up 2.5%. Once we get out of this macro worries, all of these issues sort of weighing on things, maybe we can look at some of these earnings and take positives out of them. And I feel like that's what happened a little bit with the banks today. When you take a look at stocks like JP Morgan, Goldman Sachs, et cetera, they all had great days after posting positive earnings. So you feel like maybe we're opening up for, can we now just look at earnings rather than worrying about macro and worrying about Trump tweets every single day.
It was interesting, though. I also think with some of these banks, and broadly solid reports to kick off the earnings season, I just wanted to, I wonder how many investors look ahead and they think what they do, I wonder what does Trump 2.0 mean for this sector, just in terms of positives. I mean, just the regulatory backdrop, capital requirements, right?
And a final thing I'll hit on that too, Josh. We saw a pretty big rally in regional banks today, and we didn't really have a lot of regional banks report, right? So it'll be interesting to see, does this rally stick once these companies actually report? Regional banks have been sort of a Trump trade, so to speak. How does that actually play out when we get to the fundamental story? That'll be a trend to watch over the next couple of days.
We shall see. Thank you, Josh. Earlier this week, Brown-Forman, parent company of Jack Daniel's Whiskey and Woodford Reserve Bourbon, announcing it would be laying off about 12% of its staff amid a downturn in sales. There could be more bad news to come for the spirits industry, with Donald Trump set to re-enter the White House next week and new tariffs expected to follow. The last time, remember, Trump was in office, American whiskey exports plunged globally thanks to retaliatory tariffs. And joining us now to talk about all this, Chris Swanger, Distilled Spirits Council CEO. Chris, it is good to see you. So let's talk about some of these recent headlines, Chris, on your industry. We just mentioned Brown-Forman, going to cut about 12% of the workforce. And then, Chris, I know you saw this one. The Journal had that piece, Chris. I had friends texting me that one. That got some headlines. America's bourbon boom is over, they said, Chris. I'm just curious. Let's start at a high level. You look at your industry. How healthy, how strong is it right now?
Well, it is a strong and vibrant industry, no doubt. And certainly Brown-Forman is a great American company. And there has been a boom for American whiskey over the years. And certainly when those tariffs were imposed by the EU a couple of years ago, we saw a 25% decline in American whiskey exports to the EU. So our market has constricted all beverage alcohol. That is due to a variety of reasons: inflation challenges, supply chain challenges. We appreciate President Trump's leadership in getting ahead of the Eastern Shore port strike, the longshoreman port strike, where that was coming up. And under his leadership, that's been resolved. But yeah, these are anxious times, no doubt, and look forward to talking to you about the tariffs and the challenges associated with that.
I do want to get to Trump and the tariffs, Chris, critical. But first, let me just go back to this article we saw, America's bourbon boom is over, because I thought it was interesting. I mean, sales volumes of U.S. whiskeys, according to the Journal, including bourbon, they dropped 1.2% in 2023. That was the first fall since 2002. That dropped steep, and they say, last year, with volumes down 4% in the first 9 months of 2024. I know that both of us, Chris, we are bourbon fans. I'm just curious,
no doubt,
what is going on there? I assume it's multifactorial, but what are the variables as you see it?
We've seen great growth for American whiskey over the last 10, 15 years, and an exciting time, both here in the United States and export markets as well. The entire beverage alcohol industry and the hospitality industry is suffering from a little bit of a constriction in the marketplace. And again, as I mentioned, supply chain challenges, inflation challenges, and so forth. So we are looking forward to working with the Trump administration coming in, because he is about America's open for business. And that includes the hospitality sector, the bars, the restaurants, and the distilled spirits industry as well. So we're excited about the prospects of a booming economy. I know President Trump wants to create wealth and create a strong economy, and the hospitality industry needs to be a part of that.
So you mentioned Trump, so let's dig into that, Chris, because if you're talking Trump, you're talking tariffs. I mean, he is a believer, right? And you look at his economic advisors, the team he's assembled. Bessent is a believer. Lutnick is a believer. So how could tariffs impact your industry going forward? As you try to think through this and quantify it, what could it mean?
Well, certainly President Trump takes a very aggressive approach when it comes to trade policy. And we appreciate that. He wants to reduce the U.S. trade deficit. He wants to create American jobs. Our industry got caught up in a trade tariff tit for tat back in June 2018, when unfortunately the EU imposed a 25% tariff on American whiskey. And when that happened, it created a tit for tat between the U.S. and the EU. And distilled spirits wasn't even really a part of the equation. President Trump was leaning in hard to create more aluminum and steel production at the time. And unfortunately, the EU fired the first shot. Now, I must say, this is a warning shot, and it's something that we're going to work with the Trump administration on. I'm going to Brussels in a couple of weeks. At the end of March 2025, the tariff on American whiskey could be imposed by the EU, a 50% tariff. So it's very, very critical that our great trading partners, that where we make a lot of distilled spirits in the EU, cognac, Scotch whiskey, Irish whiskey, EU and the UK, of course, in Mexico, tequila, Canadian whiskey in Canada. And the industry is very, very integrated. So, and we're distinctive products. You can only make American whiskey in the United States. You can only make cognac in the Jarnac region of France. So our products aren't a commodity. And in order to keep the American whiskey market booming is to make sure that our trading partners don't impose tariffs on them. And we're going to try to work with the Trump administration, Mexico, Canada, and the EU to make sure they all understand the distinctive nature of distilled spirits products.
Chris, great to see you. Thank you for coming on the show. Appreciate it.
Thanks, Josh. Cheers, everyone.
Stick around. Much more Ask for a Trend still to come. Robotics is one of the biggest themes coming out of this year's Consumer Electronics Show, but robots aren't just for the future anymore. They're here now, and our next guest company is building them to help solve a variety of issues facing our country. Joining us now is Jake Luce-Ararian, CEO of Gecko Robotics, and Yahoo Finance's Julie Hyman. Jake, it is good to see you. So advanced robotics, AI-powered software, lots of companies, Jake, large and small, excited, interested, investing in these themes. What makes your robots different, Jake?
Yeah, great question. Well, thanks for having me on. It's great to be here. Yeah, it was exciting. The year of the robot is kind of what 2025 has been labeled, and that's very exciting for us. I built Gecko out of a college dorm about 12 years ago, so it's exciting that the year is finally here. But basically what Gecko does is we build robotic systems that are climbing walls, that are flying around, walking around at some of the most important places that you don't typically see robots. Industrial facilities like power plants, a naval shipyard trying to get our Navy out of dry dock and helping to deter conflict faster, bridges, refineries. We're basically trying to go out and gather the most robust and richest data sets on the health of the things that we rely on the most in the world. And then from all that data, we're then able to use a data platform we call Cantilever to help understand when things will fail, how to make infrastructure way more reliable and way more impactful for both the commercial and the government sectors. And so it's been incredible to be able to develop technology that's so cool, but also really, really helps companies and the government.
And Jake, it's interesting. It's good to see you again. I met you, I guess, about a year ago now. And as you said, you guys have been developing these robots for some time. And I think most people, when we're talking robots, they're picturing something like the Tesla bot or more of a humanoid type of robot figure, et cetera. Your robots don't look like people, right? So tell us, get sort of granular with us. Give us some examples of what they look like and what specifically they're doing.
Yeah, they barely even look like geckos, actually. But yeah, it's great to see you again. It was a little colder last time we spoke at Davos. But yeah, so the robots, what we're doing is, early on, I kind of thought about this whole like space of information and data sets. And we think we have all this information and data about the world. But in reality, that's not true. What I realized, 12 years ago was that we actually don't know that much about the most important atomic things, the things in the physical world. We don't really know much about the data and the health and how these things operate. And so when we get to the place where artificial intelligence is taking over everything, and software is eating the world, funny enough, it turns out that if you don't actually have data for the built world, you don't actually see a lot of AI impact in that built world. And so we build robots that are going out there and collecting information and data that are turning atoms into bits to help us create a foundational model that leverages artificial intelligence to help folks that are running energy facilities or deploying our ships to deter conflict around the world, help them understand how long do these assets have to have before they break, how do you fix them and get them out there doing their job more efficiently, how do you ensure that you don't have huge explosions at refineries or power plants, and ensure that we can actually meet the current demand, both manufacturing, energy, and artificial intelligence that is critical right now. And so all of the data from the robots, whether they be the robots that we build or the ones that we'll buy from Tesla or from Figure that are walking around and getting information, or even wearables, we're talking about some of that as well. All that data needs somewhere to go to do useful things. And so that's what Gecko is all about, is getting information from sensors, building them ourselves and partnering with amazing companies to actually put those data sets to work, to keep people safe, and to ensure that we meet the moment right now.
Jake, I'm curious, how big is the market you're addressing here, and how fast is it growing?
It's a great question. So the market size is in the trillions. You think about infrastructure, you'll hear things like, hey, it's going to take $5 trillion to go from a D grade of infrastructure like bridges, railway, dams, to a B infrastructure. Basically, what you're saying is, hey, we know we have all these problems to upgrade old infrastructure into new, and it costs a lot of money. The big thing you don't know, though, is how to deploy $5 trillion most effectively. And maybe it shouldn't be 5, maybe it should be 1 trillion, but just like really targeted in terms of where you deploy that capital. That's what we're supposed to do as a company. That's what Gecko's here for, is to ensure that we're prioritizing that spend most efficiently and effectively by giving insights into the world of the physical and where things might fail. If you go to the doctor and basically we're doing things like we're like the doctors of the built world. You get like a sonogram and you can see inside and see like let's say like a baby developing inside of a belly. It's the same kind of thing. We want to know what it looks like inside of these bridges or dams and know exactly how to ensure that they're going to be reliable for us. And actually, deploy capital way more efficiently. This is how you get out of this horrible this horrible trap of investing into old stuff and deploying capital in really inefficient ways. We're trying to say this is where you deploy it really efficiently, and here's actually how you build smarter things into the future, because we've seen over 500,000 assets, how they fail and why they fail. And that's what's exciting. You can build with smarter infrastructure using the data that we've been collecting for 12 years.
Jay, great to have you on the show today. Thanks so much for joining us. Appreciate it.
You bet. Thanks.
Coming up, we're taking a closer look at core CPI from today's Consumer Price Index print. In our chart of the day, more Ashley for a trend right on the other side. Well, for our chart of the day, we're taking a closer look at core CPI from today's Consumer Price Index data. Yahoo Finance's Julie Hyman joins us now with a closer look. Julie.
So we're looking at the annualized changes in core CPI, looking at the 3-month average of this. And as I look at this chart, first of all, one of the things that strikes me is, gosh, weren't these the days? We look back on this now, but it's just sort of remarkable for how long inflation was sort of low and steady before the volatility and spikes that we had during the pandemic. Be that as it may, obviously the Fed and the markets are focused on getting inflation back down and keeping it once again at a steady level. And in the eyes of Bank of America, this is still going in the right direction and the disinflation trend is still intact. Now, what we're looking at here is core CPI here in the sort of amber color here. We've got services in blue, and we've got goods in white. And as you can see, goods have really come down. I mean, things like eggs notwithstanding, that doesn't go into the core CPI, right? This excludes food and energy. And we have seen these numbers come down. Right now, the core CPI overall is at 3.3%. And so, again, in the view of Bank of America economists, we're continuing to see all of this trend in the correct direction. The numbers that we got out this morning lending more credence to that idea and obviously encouraging the market, as we've been talking a lot about. Now, we earlier talked to Bank of America senior economist Aditya Bave about what he's going to be watching this year to see if this trend is going to continue or if we could see some kind of reaccelerating of inflation. And we talked about sort of the different components here and what he might be watching.
So I think it's dangerous to cherry pick components, but what I would say is on the reacceleration question, you probably want to watch services if you're worried about labor costs and you're worried about a very strong labor market, very strong consumer, then you would sort of assume that that would play out via services inflation, right? So you want to watch services. You probably want to watch auto prices as well. They've just been a little bit uncomfortably strong the last couple of months. We think this is a blip, but it's something worth keeping an eye on.
So going to be watching those elements. And services, which you mentioned, again here, this is the blue line that is higher. That includes things like rent, owner's equivalent rent, right? One of those areas, shelter inflation that's been particularly sticky here. So that's something that Bave and other economists are going to be watching closely, Josh.
All right. Thank you, Julie. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.